What are the pros and cons of investing in the U.S. markets versus Nigeria? What metrics should investors be aware of? What about the historical performance of markets? Are there any indicators that they should be, knowledgeable of for future performances or trends? Joining us to answer these questions is investment banking analyst Oladayo Oduwole. Dayo, you're very welcome. Good to have you with us.
Thank you for having me, Otis.
If for Nigerians looking across the pond at the U.S. wanting to invest over there, is the chief motivation higher returns?
Okay, so I'd say for investors across the world, right, there are three reasons why they would look for alternative investments and alternative instruments in alternative markets, basically. And the three reasons primarily: one, probability of higher returns; secondly, a form of dealing with future obligations. So some people might have mortgage payments to make in a different currency. They may have to pay school fees. They may have potential health concerns that they have to deal with. And then the third being the probability that dealing with potential losses to their wealth because of currency fluctuations and things of that nature. So those are the three reasons why people look for alternative returns.
Fantastic. I'm enjoying your slides here. You've got a S&P 500 NSE 20-year comparison. Yeah, so tell us about this. This is very interesting. I'm seeing if you put in $10,000, that's on the left for anyway. Our viewers can definitely see what's on there. Yeah, take us through this. What's this 20-year return performance for the NSE and the S&P 500?
Yeah, so it's a relative return bit of analysis. So say someone had 2.2 million naira in 2011, and then they decided to split it up into two, and then invest one in one market, and then invest in the other market, and then we're here to see what it looks like. So the reality is Nigeria has done very well. The Nigerian All-Share Index has done incredibly well. Over the duration of 20 years, it's returned about 216%. So if you had invested at the beginning of the year, close out your position at the end of the year, invest again and just keep with that strategy, you would have received 216% versus in the US, where you'd have received around 160%, including dividends, by the way. But the snag here is by the time you convert your US earnings to Naira, then you have that significant difference, just because of where the currency was in 2001 and then where we're at in 2020.
Are index funds, because I noticed that you're looking at, there was an S&P 500 index. Are index funds the way to go for long-term investing?
Yes, if you are a retail investor. Yes, because
you're a big fan of index funds. Just so our viewers know why we're cackling here. Yeah, go ahead. Yeah, okay.
And for retail investors, it's a cheap way of getting diversified returns with very little or investment in terms of your time and effort. But then, if you're able to get a good money manager who has a good track record and knows what they're doing effectively and will take your money, then sure, perhaps consider them as an alternative for foreign investing. Yeah.
Great stuff. I think up next, it's price earnings ratio, historical performance for the S&P 500. First of all, for the sake of our viewers, this is dividend yield. We should be looking at the price earnings ratio, but for what's the define the PE ratio. That's the price to earnings ratio.
Okay, so price to earnings ratio is very simple. It's a ratio basically of current prices to historical earnings. So if a stock is priced at 40 naira today, and then their earnings is at earnings per share is 2 naira per share, then effectively that's a 20-time multiple. And what it really means is how long it'll take you for you to enjoy part of those earnings, basically. So if the price earnings ratio is about 20 times, then it potentially means that you'd have to wait 20 years before you can fully recoup that price that you have paid for that investment.
Fantastic.
Effectively.
Thank you. All right. So what's that? +3, the SD, standard deviations?
Yes.
And also +2 standard deviations. So what are we seeing here with historically how the S&P 500's PE ratio has performed?
Absolutely. So from my perspective, I try to look at things quantitatively. So if you're looking at things quantitatively, you would not necessarily look at the price and look at where things are. You may want to look at it from deviations from the norm, deviations from the mean.
Okay.
So what this chart is showing is the deviations from the mean. The average for the S&P over the last 60 odd years has been 18 times, right? So you'd wait 18 years to be able to enjoy the price that you've paid, basically. So 2 standard deviations away from that means you're 2 standard deviations from the norm, that 18. By the time you start moving to 3 standard deviations, things start to look a bit funny because it means you're paying a lot of money away from the mean to get returns that you may have to wait 40 years for. So
you're paying more than normal?
Effectively, yes.
Right. Okay.
Yes, effectively.
Right.
I mean, it's an opinion. It's not reality. But it's just an opinion from all the market makers, effectively.
Fantastic. All right, then this is what a lot of people like here. Dividends. A lot of investors are down with it. And the lady here you have there, she doesn't look very happy because it looks like the dividend yield, historical dividend yield performance has been trending downwards.
Yes. So again, it's a ratio, right? It's ratio of dividends per share to the price. So if the price you're paying is going up, and then the dividends are relatively static or they're not growing as quickly, then the ratio goes down, and that's what's happening. And I had done a bit of analysis in the past, especially regarding Nigeria, as to what has a stronger indication of performance. It turns out it's a dividend yield. So if dividend yields are incredibly low, then I'll be concerned putting my money in a market where effectively dividend yield is around 1%.
Great stuff. For the folks thinking of hopping into the United States, have to take that into account. If dividends are trending downwards, well, okay, the 2 keys, I guess, is capital appreciation and dividends. Those are the 2 twin-headed bonuses there. Okay, next up, I believe we are looking at the historical 10-year Treasury yield. So the Treasury yields have been in the news very recently because of their recent rise. What's your account for what we're seeing with their historical performance here?
So historically, what we can see, or what we've seen, is they've trended downwards. And why is this important? It's important because it goes into the pricing of equities, the pricing of stocks, effectively. So as prices tend downwards, or as the yields tend towards zero, it means that your discount, your effective discount of future cash flows or future dividends is going to generate higher numbers. So as we see, or where we are in the market today, what we're seeing all sorts of valuations. We're seeing very, very large numbers. You see very large numbers when you discount using smaller rates, effectively. So as an example, say you were expecting ₦1 million in a year's time. If I discount using 10% to bring it to today's value, I'll probably get 909,000 naira. Right? If I discount at 20%, I'll be getting 883.333, that number there. But then if I discount at 5%, then that's 990 as opposed to 900 before. So the lower the discount factor, the higher the present value. So when someone says a company is worth 50 billion today, I think we know why it's worth 50 billion.
Time value of money, Harry Markowitz, what can we learn from the wise words of Harry Markowitz?
Okay, so he's one of the pioneers in terms of portfolio management and portfolio investing and the quantitative side of things. And he was the first person one of the first people, to be correct, to demonstrate the impact of diversification on people's portfolios. So diversification effectively is the only free lunch, they say, in finance. So in terms of thinking about portfolios and thinking about performance and thinking about investments, then it's important to think about diversifying some of the returns. And sometimes it's helpful to look at alternative markets and alternative investments.
Hence the US-Nigeria comparison.
Yes.
Fantastic. And I noticed, we've got about, I think, 60 seconds? Okay, about 60 seconds if you can. Looking at 2030 and beyond, Dayo. How is that you?
That's it. It looks like me.
Looking at 2030 real quick if you can.
Yes, so I mean, other than just looking at one large index that covers the market or looking at specific stocks, if you're interested in benefiting from the rise for the next 10, 20 years, you want to be looking at climate change funds, climate impact funds. You want to be looking at sustainable stocks, businesses that are into sustainability. The right of repair is very important. That will be important over the next 10, 15 years.
Oladayo Oduwole, investment banking analyst. Always a pleasure. We learned so much whenever you're on the program. Really appreciate you giving your insights there, and thank you so much for joining us.